energy efficiency and therefore cost efficiency that make it worthwhile, you need to be at this very, very, very small scale. And the argument that the US has been making is that doing this is actually stopping stopping the Chinese more broadly from being able to compete in that space, right? Others will say, oh, it's actually just about the Chinese economy as a whole and trying to prevent them from usurping the US. There are a lot of things that China is going to find hard to do when it comes to the AI revolution if it doesn't have the best semiconductors. There's lots it still can do, of course, but the most recent round of sanctions, the US has said, well, actually, we want to ensure they can't get access to cloud computing, right? So it's all very well saying, well, we're not going to let these things go into China, but if China can use cloud computing or cloud servers that are located in, for argument's sake, Singapore, well, then it all becomes slightly redundant. So the US has stopped their access to that as well. It is all about that next generation of AI innovation and what those applications are for.
Just on chips, just on advanced technology, let's just do this in years and sum it up. Alex, how many years behind do you think the Chinese effort is now, relative to where we thought it was?
I mean, look, it's hard because there's so many different pieces to this puzzle.
Sure.
You could say, look, 7 nanometers have been around for in sort of broad, large scale applications for maybe 6-7 years, right? So that's where they are. That's where they've got to. Getting to that 3 nanometer is a lot harder because the hurdle of getting into extreme ultraviolet lithography is massive, right? That is a big leap to get to that point. Lots of people were skeptical that EUV would ever happen. In fact, that's one of the reasons that Intel kind of missed out on it, that they were not convinced that it would ever be possible. It ultimately proved to be the case. There is a long way to go from this to the next phase.
Alex Webb, thanks for the update. The update out of London. TK, this is quite a win for China versus the United States, that's for sure, bottom line.
I think it's a huge wake-up call, and again, the Bloomberg article is just absolutely superb out of our Asian effort. And Alex, educate me on, where they are. And my answer is they go from 7 to 6, and then they have this process, lithography, whatever it is, where they get to 3. Why won't they be able to do that? They've been doing it for hundreds of years. I mean,
and they do it so quietly.
They
did it so quietly in the last week.
Yeah.
Secretary comes over there, starts preaching about what they need to change to make the country investable again, and then they just quietly release this, Tom, under the radar.
There's a number of stories here involving politics and that, but just on raw technology, I don't understand how this goes over to our legitimate defense worries about China.
And they are legitimate.
Like submarine telemetry, just talking off the top of my head. I don't know where this heads. It's a phenomenal story. I'll put it out on Twitter here.
Coming up in the next hour, Chris Heisey of
I trust my wealth to Northern Trust.
Northern Trust has the deep expertise I need.
With over 30 unique disciplines.
From the traditional to the disruptive.
From investing and taxes.
To cybersecurity and blockchain.
I want a wealth manager who sees where the world is going.
And understands how to get me and my family there.
That's why I work with Northern Trust.
That's why I work with Northern Trust. That's why I work with Northern Trust.
Northern Trust, for where wealth goes next.
Every weekday at 5 p.m. Eastern Time, join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
We've all been there. You get invited to go to Kyrgyzstan, where you're turned into a YouTube kids show star. Build a satellite and play a game with a goat. point is, Hello World is back, and you should watch it. Thursdays on Bloomberg Originals and Bloomberg TV.
We're investing a lot in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
The distortions in the labor market are gradually wringing themselves out of the system.
The labor market is gradually softening, but not cratering.
This is exactly what the Fed is looking for in terms of getting the normalization in the labor market.
The labor market holds the key to whether you can pull off that soft landing.
Over the course of next year into 2025, I think employment is going to continue to slow. The Fed's going to get its way with the labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene all together, back together again. It's back to school. It's back to the real world of equities, bonds, currencies, commodities. 18 stories to talk about this morning. John, real simple. The real yield buttressed right up against the high seen middle of August. I got a real yield 1.94%. That's a ginormous statistic this morning.
High for longer, but maybe not higher. Seems to be the take at the moment. September off the table after the data we had from last week, September 20th. The decision from the Federal Reserve, that may be still hanging, Tom, lingering
When's
around
inflation?
CPI.
13th, day before ECB.
Of September. So next Wednesday.
Yeah.
ECB on the 14th, next Thursday.
It's going to be an extravaganza before we go to London here. And, you know, I'm sorry, you get an inflation surprise.
Oh, we're making the London announcement.
Well, of course we are.
Don't slip that in. What are we doing over there?
Well, the tots, I mean, the schedule, I'm really looking at like Arsenal.
We're going to watch football. We're just going for the North London
derby.
derby.
We're going for the derby.
Okay.
Lisa's going to come too.
Does Bramo know?
Thanks.
Bramo, three of us.
Okay.
Arsenal,
Great.
Football, red. They wear red.
Thanks. Oh,
Everyone
great.
I know.
Bramo's an Arsenal fan.
Yeah.
Everybody I know is for Arsenal.
Yeah.
Over there.
A gunner.
That's a gunner.
Bramo is a gunner too.
Kit Jukes.
There you go. Kit Jukes is also a gunner.
That's where we are. But John, I think
Good to know.
it's a toxic brew of post-Labor Day stories this
But
morning.
it hasn't been that toxic.
No.
In fact, you would have to say the doves on the Federal Reserve have more ammunition after the data of the last week. And I can share with you some comments from the likes of Mike Gabe and Bank of America saying that the labour market supply and demand coming into balance a little bit more. Alan Zettner, Morgan Stanley, had this to say: the report continues to point to a labour market that is softening but not falling off a cliff, keeping a hike in September off the table in their view. They're not alone. But then you introduce, Tom, and I think this is the conversation we'll have this hour, Goldman Sachs saying 15% chance of recession, that the long and variable lags may well be behind us by the time we get into 2024. Neil Dutter of Renmac, that conversation 28 minutes away. He's talked up an economy that's outperforming, above trend growth, that could well reintroduce inflation re-accelerating at a Fed that may well have more work to do.
But Lisa, if it's not 15% recession, it's 85% what? If I did the math right.
There's a theme emerging this morning, and I think that it's not a toxic brew at all. It's the opposite. But there's a question of what this looks like. And we heard from Steve Chiavarone of Federated. He's bullish on U.S. equities because it's the area of growth. And then we heard from Katie Kaminsky that this could mean that bond yields are higher for longer. You put these two things together, this idea that you don't necessarily need to see the Fed cutting rates anytime soon because the long and variable lags aren't that long, aren't that variable, like Goldman Sachs had to say. So that leaves us in a new rate regime, and people are sort of going back to that idea.
Overcome by events. Katie Kaminsky, I adore. Love her trend-based work. John, 88.41 on Brent crude, and she made clear that's a trend. Alpha sites, whatever it is, they're looking
Simplex.
at. Alpha Simplex.
Alpha
What's it?
size.
Alpha. They made.
You two get this settled, and then I'll jump back
in. Semiconductors.
Okay, oil. You want to talk about Brent?
Brent crude.
Do you see the move in crude as a reflection of economic improvement? This expansion going longer than expected, or a reflection of what's happening on the supply side?
I look at it as
if it's the demand side,
post-COVID.
okay. If it's the demand side, Tom, then maybe you can make the argument the Fed might have more work to do here. If it's the supply side, then it might be the recipe for a slowdown regardless. I think how you frame this, Tom, is important. The move in the last week, lots of people might say that's down to Russia cutting back and maybe the Saudis set to follow going into OPEC. But, Tom, I'm with you. Iron ore back to April highs.
Exactly.
Crude's
Thank
up
you.
there
I looked
too.
this morning.
There's a lot out there on the commodity side
How do you
suggesting
search for
that
iron ore on the Bloomberg? You just go iron ore?
It used to be Tianjin. It used to be a different... I used to look at a different benchmark.
I agree. Different benchmark. But let me open this up because I didn't get to ask one of our guests this. What's the gloom trade right now? What's the weight of people gloomy on the market? I can't get a handle on that. I mean, how many people are gloomy on the stock market?
So Jim Bianco of Bianco Research is going to join me later on the bond market in about 55 minutes.
Yeah,
and what is consensus right now? Jim believes consensus in the bond market is still bullish, long, yields lower.
Yeah, and we heard some people pushing against it. But
he thinks you should lean the other
market,
way.
What's the gloom bet right now in the stock market? I don't have a handle.
There are people who come out and say that there isn't one, and that's been a problem for them, that they'd like to see more baked in. And then others say, if you look at the options market, it's not as rosy as people previously expected. So there is enough gloom to make some people bullish even further.
We pulled back when you guys weren't here Friday from a 13-level VIX to 14.19.
This is market roulette this morning, TK.
It is. I mean, the VIX is 14.19. I mean, it's gloom out there.
I'll throw the euro at you.
Thank you.
Euro just about holding on to 107 at the moment. It's on 107.34.
I agree.
Near session lows.
Right now,
0.6%.
Our guest is so important, we've got to get to him right away. James Karen is CIO of Portfolio Solutions Group at Morgan Stanley, with decades of experience on his bond market, and also it folds into everything else. Jim, we're playing data roulette here, as John puts it, this morning. How do you interpret Brent crude on the edge of a moonshot up to near $90 a barrel? How does that change your world?
Well, I think, when I think about oil, I always think about the demand that goes into it, right? So is this a sign? I mean, clearly there are technical indicators for oil in terms of supply and demand. All that stuff goes into it. But could it also be that global demand isn't as soft as people think? I mean, yes, things are slowing down, but could it be that the production isn't enough to actually sustain, a softer landing, whether it's in the U.S. or even globally? Yes, things are slowing, but they're not collapsing. And I think that's the key. And I think that's one of the things that's probably going to be somewhat supportive of oil, that plus some of the technicals in terms of the undersupply.
Jim, let's talk about the equity market. You cover that now too. We spoke to Steve Cheverone of Federated Hermes. He reckons this rally has got legs. Do you share that belief that maybe this rally has got legs? I remember conversations that you and I had at the start of the year, and we were talking about risk, and you made the point that downside risk is something we're all talking about. Upside risk is something we need to appreciate a little bit more. What about now, Jim?
Yeah, I'm still in that camp. I mean, look, I want to be very clear. I do think the economy there is a slowdown that's underway, that there's no question, but I don't think people are positioned for it. And I think that's one of the real key factors, meaning that when we look at equity positions right now, positioning in equities, I should say, isn't necessarily overly long. So therefore, the market's vulnerable to move higher on modestly good news or less disappointing news. So look, take 2Q earnings. 2Q earnings were supposed to be down 7%. They came down to 4%. Okay, that's not a good number, but it's a lot better than where it was or what people were thinking. And if we think about the third quarter earnings might be flat to slightly positive. This could be the inflection point, and this is something that investors typically like to buy into when there's an inflection from negative earnings growth to potentially positive. So, and given the fact that people aren't overly positioned long in equities right now, then I think that there could be some possible legs as long as we don't get the disappointment.
Well, what disappointment are we really talking about here? Are we talking about the disappointment in earnings, or are we talking about the disappointment that, oh yeah, if growth can continue keep chugging along, even with yields where they are, maybe yields can stay here for that much longer and even go higher? The Katie Kaminsky view of the world.
Yeah, so that's a great question, Lisa. So I think you're right. I mean, it's the disappointment in the growth, right? So right now, everybody's focused on, a recession, an upcoming recession that's supposed to happen. Yet, third quarter GDP estimates are being upgraded, not downgraded right now. So, okay, we may be slowing, but we're also getting some pretty good tailwinds that tell us that the slowdown in the potential economy, going forward into the fourth quarter and maybe into early next year might not be as bad. So I have a lot of sympathy for what Jan Hatzius at Goldman Sachs is actually saying, which is that you could have a softer landing here. And I still don't think people are positioned that way. So something that John and I was speaking about at the beginning of the year was that risk on is a risk, and like any other risk, it needs to be hedged. And I don't think that people have enough risk in their overall portfolios in terms of the balance of equities relative to fixed income. I still think that, people believe it's the year of the bond market and that bond yields are going much lower. I kind of lean against that too, sort of like my colleague Jim Bianco does. I think that we could be getting a little bit of a push higher in yields.
Okay, so this really is the question. If you believe in Jan Hatzius' view of the world, you also believe that the long and variable lags has been overplayed and that that's actually not really going to factor into any kind of slowdown, that what you see is what you get in terms of the strength?
Yeah, so that's where I push back a little bit on that call. So essentially, the fact of the matter is that interest rates are high. Financial conditions in that sense should be tightening. I mean, certainly the banking sector and what have you. So it's not like that just goes away, right? So it's not like those long and variable lags in that sense go away. But the long and variable lags in terms of whether it could be potentially employment, it could be growth in other sectors of the markets, particularly the value sectors of the markets, those sectors could actually stand to do a lot better. So while we're looking at very sector specific areas like, growth and technology, which have done, very, very well this year, certainly those may still get impacted later on. But I think the broader sectors of the marketplace, like the materials, the industrials, and even some of the consumer staples and discretionary, could actually start to do better.
Jim, just quickly, November hike, still in play?
Not in my mind. Not at this point. We would have to see some change in the data.
Okay. Jim Caron there of Morgan Stanley. That next big data point, September 13th, a week or so away. Just going into that ECB meeting on the 13th is the CPI report, Tom. September 14th is the ECB meeting.
Well, we got a whole bunch of dates coming up here. We got September 13th CPI, September 14th ECB. More important, September 17th, Formula One in Singapore.
Nice.
Which will be interesting as well. Then we got the 20th, which is FOMC. And, I think Arsenal we can make. The three of us would be great.
Is that the 24th?
24th, sort of
something
on the way
like
to
that.
Heathrow. And then the 30th is Liverpool is at Tottenham.
Didn't know that. Okay.
Today is like the 104th, whatever, anniversary of the advent of the Tots. So,
Are you celebrating?
Well, no, I was going to take the day off and celebrate, but I got to be out tomorrow. Afterthought starts school tomorrow. So,
okay, so you're taking tomorrow off?
Yeah, you walk. Well,
so you drink
actually,
tonight and
you don't walk them
toast
to
the club?
John, you don't walk them to school anymore. They walk 6 feet in front of you, so they're not with you.
Well, when they're teenagers, that tends to happen, Tom.
They walk like 15, 20. Hey, you.
I think it's sweet you're still walking them to school.
It's
very
sensitive.
sweet.
Yeah.
That's very kind.
She's got a lifetime pass to
Ramo will be here.
Yeah, I will be here for the first day of school.
On your way, children.
100%.
If you're just tuning in, welcome to the program. The S&P a negative here by 0.1%. Coming up a little bit later, Neil Dutt of Renaissance Macro, 8:30 Eastern Time. Tom, 17 minutes away, just defying the gloom, the doom in this economy. Neil's call all year.
Whether you are cautious or not, this is the conversation of the day, as Mr. Dutta rephrases his brilliance of 18 months ago. He really was extraordinary. He was lonely. number.
But it's not lonely anymore.
Not lonely anymore, no.
Not lonely at all. Coming up in the next hour on Bloomberg TV, going into the opening bout, Jim Bianco of Bianco Research, Stuart Kaiser of Citi, Tiffany Wilding of PIMCO. PIMCO early this year, the middle of this year in June, put out their secular outlook, and led by the former Fed Vice Chair, Richard Clarida, talked about tolerating 2-point-something. 2-point-something and tolerating that inflation level, Tom, I think has quickly become the consensus view amongst a lot of people going into year-end and into next year.
The former vice chairman leading on that, and I'm going to go back to the 10-year yield as the barometer, the real yield 1.95%. Ian Lincoln has it up 2.0-something% is maybe his upper bound. History says we get back to that. There's a raging debate about what the real yield does here into Q4.
The question is, particularly going into an election year, is this Fed willing to destroy the labour market to get inflation down 100 basis points? That's still the question, isn't it?
Yes, it's still the question. You know, Andrew Hollenhorst was brilliant last week when you were not here, and you know, I mean, the fact is, I'm looking forward to Stuart Kaiser. I think
just to be clear,
Northern Trust has the expertise that I need.
Deep expertise.
They give me access to experts with the exact skill set I need.
So I can meet the ambitions I have for my wealth.
That's why I work with Northern Trust.
Northern Trust, for where wealth goes next.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
We want to connect this inflation story. The thing we're watching is the oil market. The reason that is important is because that is one of the indicators, at least when we've seen inflation data down the pipeline. Brent crude has been one, for example, in 2022, that tends to be something to follow as a catalyst into where you start to see inflation numbers tick up later in the year.
On fire this morning, Katie Kaminsky really talking up the trends that she and Alpha Simplex see, and as we mentioned here 10 minutes ago, really extraordinary her view on the trend base of oil. Right now, let's quote that for you. American oil, so it looks like it's a Brent price, $85.29 on West Texas Intermediate, $88.38 with a dash near 89 earlier this morning. I'm Brent Crude. Lisa, you and I were talking about this on the break, and to me, it's the story of Q4 that's undermodeled right now is how I'd put it.
I could not agree more. Honestly, it's not just the oil sector. We've talked about some of the other commodities as well.
John mentioned iron ore.
Iron ore,
yeah.
Also food. And you've seen this in emerging markets really creep up where food costs are going up significantly. At what point does that challenge the idea of this disinflation in the U.S. if you have gas prices, if you have oil prices climbing at a significant pace?
Yeah, I want to mention right now along that line, as you mentioned food here, my book of the year has just come out in the last week. It is hugely anticipated. This is Robert D. Kaplan. He's had my book of the summer and book of the year before. and he is absolutely exquisite on geopolitics. It's the loom of time, and I just really can't say enough about it. I put it out on Twitter last night. I'll do it again here.
Especially at a time where you see rice in Southeast Asia, prices climbing back toward the highest in 15 years. Just a changing dynamic around the margins that isn't getting talked about a lot. Maybe it's just because of the supply side. Either way, what that does going forward could shape at least the next couple of months.
Right now, we're going to frame out your next couple of months. There's a loom, Robert T. Kaplan, The Loom of Time, folks. On radio, it is absolutely brilliant, 300-plus pages, a tour de force by Kaplan. You know him from Marco Polo's World from a number of years ago. Right now, in the equity markets, we frame it with Chris Heisey, Chief Investment Officer of Merrill and Bank of America Private Bank. Chris, I love your note. You've got to participate, but you're scared stiff. How do you participate in equities if you're scared stiff?
Yeah, I think you have to first start with a plan. You can't go into anything where there's a lot of cross currents without a plan. So you also almost have to have an understanding that you're going to have a lot of choppiness in the markets, particularly when you've got cross currents, whether it's inflation, the energy markets, food prices, the labor market, which is now normalizing again, and almost back to normal, frankly. And then finally, you've got a slowdown in China. You still have the war in Ukraine. There's so many things to fear. So you want to look at weakness in the markets, use it as a dollar cost averaging approach. We call this a market environment overcast. It's not sunny. It's not raining. And those are the markets that kind of, dismay you. They make you stay on the sidelines longer than you should. So have a plan, be ready. And in particular, you shouldn't be underweight equities at this point in the cycle. That's our plan.
What point in the cycle are we, Chris?
Well, that's a good one. It's blurred lines between late and somewhere in the limbo part between late and early. We're all waiting to see the signs that the Fed is done. But unfortunately, when the Fed does cut, they usually cut for a reason. And that's usually because growth is coming down sharply. The labor markets have already peaked as in terms of employment. And then ultimately, they have to do something. So everyone's thinking that that's going to be in the spring of next year. We don't really know when it's going to be. No one will know until the data starts to pull through that way. And at that point, that's when you should start to see earnings begin to discount something better on a second half of 24 basis. But markets don't wait for that. We all know that. So the second or third cut is usually when markets begin to climb that wall of worry. So between now and then, we're in limbo, and that's like a late cycle type of move.
And we are seeing right now, at least according to some estimates, that Wall Street is raising quarterly profit earnings at the highest pace going back 2 years. So that's sort of where some of what you're talking about does come into the fore. That said, is there some sort of incoherence here with this idea of betting on rate cuts at a time where growth is continuing to chug along? We've got concerns about commodity inflation, and a lot of people are saying higher yields for longer seems like the most likely outcome going forward.
That's such a great question, because this is the whole issue that's going on and why there's still so much cash at the short end of the curve. This is not a normal storybook. The distortions coming out of the pandemic and through the pandemic have basically balanced out a lot of the things that would have normally happened. So you've got this overage in some places, and then you've got this slowdown in China mixed with whether or not the Fed is going to continue to keep real yields where they are or actually expand them. So for what it's worth, I think the earnings side of the equation, most of Wall Street believes that the second quarter was the trough. Our view is going to be it's going to be a bumpy earnings progression. And then ultimately next year, you start to grow again for real. This point in time in the cycle, you generally get better economic numbers right before you don't.
Chris, I want you to address a traditional 60-40, or dare I say 60-30-10 allocation in the partial differential of cash right now. Now, buttressed against that in the equation is a 5% yield on cash, money market, whatever. But how do you utilize cash as a tool to get out 3 years to that equity optimism?
Tom, that's perfect. Cash at the short end should be used if it's investable. In other words, if you're waiting to invest those dollars, that cash 5.5% should be viewed as cash flow for investment. So if you get weakness in September, which you typically do, right around potential worries of potential government shutdown. Use that cash flow into the equity markets, particularly if you're underweight. And then over a 2 to 3 year period where earnings are now back on track, they're growing again. Yeah. The economy is away from the distortions. So we use that as a tool. That's a very good way to think about it.
What do you say to people that are just downright cautious on the market? We have coming up, folks, in about 25 minutes, David Rubenstein, and we will talk about the wonderful Jeremy Grantham of GMO. And Jeremy Grantham has been really, really cautious on stocks for a really long time. I'm going to call it 3 years. How do you address those people and say, you got to participate if you want to retire, if you've got goals down the road?
I think number one, I think it's important to understand that all different types of cycles have different catalysts to them. They may be core in their nature as to how it works, how money flow works, from one asset class to another. The relative movement of yields relative to the earnings yield in the S&P, all those things are fundamentally fine as it relates to how to think about it. But there's major drivers of this new economy. I would argue that the innovation cycle in this new economy, and even in the last decade or so, constantly reinvents itself much quicker than ever before. So you can go into a new profit cycle much quicker. Therefore, the valuations in this type of market almost have to be higher than traditional cycles of the past, where you didn't have the same innovation speed that you have today. That doesn't mean it's completely different, but it certainly means that there's always something to worry about. And usually when the worries are so high and those worries don't pull through as large as you expected, you get a good market.
Chris, thank you so much. Chris Heiser with us with Merrill and Bank of America Private Bank. Lisa, to go from Jim Caron, who I thought was fabulous across asset, to Chris Heiser, who's talking to people, what do I do forward, whether they did get the bull market of October or the 2-year bull market. And then to go to Neil Duddick coming up, who's an outright optimist. It frames people that are almost frozen. And you got to say, let it go. You've got to invest. But the percentage of people out there frozen right now is substantial.
None of those people were frozen. They were saying you need to own bonds, you need to own stocks rather, and you need to go in.
But that's their
more
job.
significantly.
I mean, come on, they're talking their book.
Well, to some degree, but you heard earlier this year, be cautious, be cautious, be cautious. Cash is good, and now you're not hearing that. You were saying earlier, why can't some of these stock bulls get some love? They are everywhere. I think it seems like a lot of the strategists are saying it seems like this does have room to run. I just think it's a confusing economy right now. I don't think that anyone really has a handle on exactly which cross current's going to win out.
Shout out to our team for a set of great voices as we come back from summer -10. Good morning.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it.
I trust my wealth to Northern Trust.
Northern Trust has the deep expertise I need.
With over 30 unique disciplines.
From the traditional to the disruptive.
From investing and taxes.
To cybersecurity and blockchain.
I want a wealth manager who sees where the world is going.
And understands how to get me and my family there.
That's why I work with Northern Trust.
That's why I work with Northern Trust.
That's why I work with Northern Trust.
Northern Trust, for where wealth goes next.
Bloomberg Surveillance, and we say good morning to you, good September to you, good back to school to you. It's sort of New Year's. I've always felt that this is New Year's. Maybe not now, maybe it's Wednesday or Thursday, or
maybe when the kids actually leave.
With a new thing, September 15th. We're going to be going off to London. We are thrilled to tell you that Surveillance, the entire team, we got 40 people on a plane. They're actually on separate planes. Lisa, John, and I can't travel together. That's part of our agreement. There's too much risk. But we're all going to London. It's like 40 people, and we're just going to have a hell of a good time talking to British voices. And this comes off, I believe, we were on the plane the day after the ECB meeting, so it'll be interesting to see.
Yeah, immediately to get on-the-ground response to what Europe is doing, even though that's not the Bank of England. Team coverage of ECB decisions and what we do with the Bank of England.
It's going to be interesting to see, and over the weekend, there's so much news over the weekend, Lisa, but one of the things I saw, and I thought the FT coming out of London, not on Labor Day, did a great job on this, the miss on growth in the United Kingdom was biggish. It was demonstrable how much better the United Kingdom has done versus the gloom that was out there a year ago.
Did you see services PMI coming out today at the UK? It was very different than what we saw out of the rest of the European region because they actually outperformed. Look, I just really can't say enough that Diane Swank on Twitter, when she came out and she said, I am humble enough to know what happened these last 3 years was complex and interrelated in ways we will be figuring out to a long time to come. This is a complicated moment. We hear about tech innovation. We hear about some of the psychological impacts from COVID. We think about the decoupling of global economies. You put it together and you have a stew of uncertainty that's leaving a lot of people thinking maybe we're even starting a new economic and market cycle.
Or given the shocks you mentioned, a partition between the tech haves and the after COVID haves.
Yeah.
And on the other side, half of America, as a generalization, flat on their back, even given a 3% GDP, which is ample, is quite good.
What do you do with that, right? The people who are getting massive wage increases. Well, and this is going to be a really important question. How has the economy really left some people out of the workforce in a material way and in perpetuity?
And perpetuity was October of last year when all of us were gloomy. Even I was gloomy. Bram was leading the charge on that and dead on into the really difficult September of 2022. And then there was something in the air. In the equity space, we heard it from the technical analysis giant, Ralph Ancampora, Edward Yardeni of Yale, C.J. Lawrence is his own shop. On top of it, get into the stock market in October of last year. And on the economic side of Y equals C plus I plus G plus NX was Neil Dutta. Very lonely, at Renaissance Macro a year ago. We're really coming on a year ago, Neil, from your Arch call. Let's review. What did you see in September of 2022?
Well, thanks for that intro, Tom. You always make me look better than I actually do.
Yeah, we try.
So I appreciate it. But, I think for me, it boiled down to something very simple, which is wage inflation was hanging in there while price inflation was coming down. I mean, that was the principal risk to the economy in the spring of 2022. You had a very aggressive Fed. You had rising food and energy prices that shocked household incomes due to the Russian invasion of Ukraine. Of course, as we got towards the end of the year, a lot of that shock had gone away while the labor markets were still kind of hanging in there. So real incomes were climbing. And that meant stronger consumer spending ultimately. And that's why the economy sort of there. And of course, remember early in the year, Tom, everyone was betting on a Fed pivot. And we saw a we saw a modest decline in mortgage rates as a result of that. But that modest drop elicited a fairly robust response in housing market activity. So there's a lot of pent-up demand there for housing. And so I think, when housing is working, it's difficult to be very bearish on the economy.
If we have disinflation or leveling of inflation, what does nominal GDP do? Because top-line GDP, your real GDP optimism with whatever inflation is, linked into revenues of corporations. What's the data nominal GDP call?
I mean, it's at least 6%.
Wow.
I mean, if you believe the last employment report, when you look at aggregate weekly income, aggregate weekly payroll, sort of the sum product of jobs, hours, and earnings, over the last 3 months, that number is up 7% at an annual rate. So, the labor market sort of impulse for nominal growth is quite strong as well. So we have an unsustainably strong economy still. And this is happening at a time when the Fed is taking, steps to the exit door. So, to me, I think the risk, and this is what I think makes me not an optimist, is that the risk is that, the Fed is prematurely declaring victory. I do see a lot of cyclical momentum in the economy right now, and the Fed stepping back. I think that could set us up for a problem as we go into 2024.
Neil, the fact that you said an unsustainably hot economy, an unsustainable level of growth in the U.S. raises this real question. What's going to make it unsustainable? Is it the inflation story that you see as resurging? We've talked about this before, and the fact that the Fed's not there, or is it just that you cannot continue in a vacuum? So at some point, it's going to implode on itself.
Well, I don't know that it'll implode on itself without the Fed doing something about it. And of course, the problems for markets are always when there's a disconnect between what the Fed wants to do and what they should do. That's when the problems come up. And, I think the Fed should not be signaling rate cuts next year. I mean, that to me is a bare, that's like a easy first thing that they should do, is not signal rate cuts. They need to maintain a tight monetary stance because, frankly, real GDP growth is running, last I checked, 6% at an annual rate over the last 3 months. Now, you can talk about revisions, you can talk about, that's not where the underlying growth rate is. But if you look at monthly GDP as of July, over the last 3 months, ending in July, it's up 6% at an annual rate. I know that's not the underlying trend, but it's above trend growth.
Well, and this is the reason why a lot of people are talking about the same thing that you are. We heard from Katie Kaminsky over at Alpha Simplex basically saying the same thing that you are in different ways. And she's bearish on bonds because she sees this coming to the fore and yields having to remain higher for longer. There is a question, though, embedded in Goldman Sachs's discussion of the long and variable lags. And maybe this is an economy that can shrug off a 5% Fed funds rate, and it's not going to matter. So at what point do you see higher bond yields as not inconsistent with higher stock prices, with higher valuations, with a continued rally in the equity market?
Well, I mean, I think right now the the combination is reasonably good for stocks, right? Because the Fed is backing off and you have strong growth. And that's so the Fed's sort of off your neck, I think, at least through the end of the year. I mean, if they're going to hike again, it'll probably be in December. So I don't really think we have to worry about the Fed, until then. And this is happening at a time when there's cyclical momentum in the economy. The fact is that goods spending, consumer spending on goods, is up over 3% against last year. And during that time, non-farm inventories have been contracting around 0.5 percentage point on average per quarter. Again, that's an unsustainable drawdown in inventory. So what are you going to see? You're going to see inventories restock. That's going to buoy manufacturing production. Again, cyclical industries. So that should be good for equities. The question is, when does the Fed wake up and realize that long and variable lags are not working out as neat and cleanly as they have in the Furbis model?
Based on the 6%
concept, they may have to step on the brakes even more so.
What does that mean, right? And that's exactly where I was going to go. How high do rates have to go in order to curtail some of what you see as unsustainable growth in the U.S.?
I mean, to me, I think that you need to keep the possibility on there for them to start to hike again in the first half of next year. At a minimum, they're going to price. I mean, I think they have 4 rate cuts priced into the summary of economic projections right now. It's hard to see that surviving in September. So, I think let's start there.
Neil, in the economics textbook, chapter 23 or 24 links all of this econobabble into the stock market. Take the data optimism, and the corporations are going to have to deal with an improved real rate. They're going to have to deal with a high nominal rate, on 3 years, 5 years of well. How does the stock market respond to that? How does the stock market react to an overweighted, optimistic data world?
Well, so I think you could call it sort of an inflationary boom. I think that might be what we're returning to. And if that's the case, that's an environment where stocks can work. But it's unambiguously bad for bonds. But for stocks, I think it's an environment where you should see continued positive returns, maybe not, somewhat below the historical norm. Obviously, if you have higher real interest rates, that hurts equities. But if you have continued growth in the economy, that means that actual and projected earnings will hang in there. So
just because of time, I got to get this in. How is an inflationary boom different now from the horror of the 60s?
Well, that was obvious. Well, the horrors of the 60s. I mean, the 60s were a reasonably good period for stock market returns and the economy. An inflationary boom, again, as I say, is something where equities can work. What you don't want is stagflation-like conditions, where productivity is coming down, where you have repeated supply shocks. That's an environment where bond returns are horrible, but stock returns are as well, because companies can't find a way to make money in that environment.
Neil, your Q4 GDP number right now. We got to get Brammo going. What's your Q4 real GDP number?
I mean, we're running so strong right now. I mean, but I think we probably slow to something like 2.5 in Q4. I think what the consensus is missing right now is that we're going to have a very robust inventory restocking on our hands. That's going to bleed into measures of factory activity.
Neil Dutta, congratulations on your economic work. He's with the Renaissance Macro Research as well. So there it is, Lisa. That's a glass half full feel. And, well, yeah, I think it is. I mean, it's a guy looking for legitimate economic growth. I don't think it's not stagflation if you got a 2-3% GDP pop. 1%, yeah, you got my attention.
One of the tensions, though, that we've seen all morning is that there is this optimism that the U.S. equity market can continue to rally and that the U.S. economy can continue to grind forward. What that means for the bond space is a very different story in terms of how high yields will go, how high yields will stay, and what that will do longer term, not only for the Fed action, but in general for companies as the price gets more expensive and as they start to just throw in the towel and raise debt anyway.
Day after Labor Day, up 5 basis points. Standard & Poor's 500 futures up 0.3%. Much going on here on a Tuesday as we plow through the week. I guess it's a quieter economic week after the festivities last week, but nevertheless, a lot of cross currents and stories today. I think we got to go back to the Pacific Rim, and barely mentioned by us today is yen weakness in over the weekend, I'm sorry, I can't remember who it was, had a real nice inflation pain story in Japan. 3% inflation for the Japanese is a shock.
Well, household spending has been going down as a result. Potentially, that's been one of the connections that people made with some data that came out over the weekend. When you talk about the Pacific Rim, I think coming up later this week, we have the G20 over in New Delhi. Over in India, and we aren't going to see Xi Jinping there. And that to me is interesting because of what Damien said. You know, in and of itself, who cares, right? But, you know, when it comes to this question of where the allegiance is of India and China, how closely connected they are at a time when China seems to be moving away from the U.S. and Europe, that's interesting to me.
You know, the U.S. participates in that dialogue. I mean, I was thinking actually of John Kenneth Galbraith. This is a few years ago. I'm thinking 40, 60 years ago in India. And we have all these legacy thoughts of India in America, most of them ancient and dated and silly. It'll be interesting to get a brief there. And of course, our team in Bombay and New Delhi leading our coverage there of the G20 meeting. This is incredibly well timed. Coming up, David Rubenstein talking to any good number of people for his show Bloomberg Wealth. David Rubenstein, I want to touch on the caution of Jeremy Grantham. From New York, after Labor Day, this is Bloomberg Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
I trust my wealth to Northern Trust.
Northern Trust has the deep expertise I need.
With over 30 unique disciplines.
From the traditional to the disruptive.
From investing and taxes.
To cybersecurity and blockchain.
I want a wealth manager who sees where the world is going.
And understands how to get me and my family there.
That's why I work with Northern Trust.
That's why I work with Northern Trust.
That's why I work with Northern Trust.
Northern Trust, for where wealth goes next.
I'm here with this caution on the stock market and equities as well. An important conversation. Look for this tonight, 9 p.m. Jeremy Grantham of GMO Boston in conversation with David Rubenstein, Bloomberg Wealth, 9 p.m. Tonight. Lisa Bramwitz and Tom King getting your autumn started. The leaves are changing in Central Park. I put out an Emily Bronte poem for John Farrell.
Yeah, I saw that.
The joy of the leaves changing.
Yeah, it was sort of, racked with angst and pain.
You were up north of Tupper Lake this weekend.
Yeah,
I mean, the leaves are already going big time.
Yeah, full time, like big red trees. And I saw a red leaf fall, and I kind of
burst
teared up.
into tears and all that. Right now, we're going to burst into tears with David Rubenstein. He joins us, of course, of the Carlyle Group, his philanthropy, including completely stacking the Duke football. We have to stop the show after talking to guard Jay Pulaski. Duke 28, Clemson 7. How did you contribute to this win?
I was calling the signals in from the sidelines.
and
people didn't know
with
that
your
I had little
support of
hand
Duke,
signals. That's what Duke did. If they'd listened to my hand signals earlier, they would have been a better team all along, but they just started listening to them.
Is this Rubenstein making Duke football a new D1 resurgent story?
It's great. We haven't had victory as big as this in quite some time.
What kind of hand signals? Like, woo!
Well, that's how Coach K won all of his championships. I would send in hand signals from the sidelines. He didn't want to tell people that.
Yeah. David Rubenstein, Jeremy Grantham. I know Jeremy for ages. I have huge respect for him, and his philanthropy speaks volumes. In your conversation with Mr. Grantham, how did you address the 4-year caution he's had on the American financial experiment?
For those who don't know, Jeremy Grantham is a man who is a very distinguished an analyst, financial analyst, and he's been quite prescient in predicting bubbles bursting, and he's really good at that. And he's predicted many bubbles that actually subsequently burst. As a result, he's got a really terrific record as an investor. But now he's spending most of his time investing in climate change and climate tech. He thinks the greatest challenge in the world now is the climate problem we have. So most of his money is in a foundation that goes towards that. But he likes to call bubbles, and he's said maybe artificial intelligence is a mini bubble. But we're now coming out of the tech bubble, and that tech bubble he forecast, and he was not involved in tech, and therefore he did pretty well for his investors. He built GMO many years ago. He's a British citizen initially, but lived in the United States after Harvard Business School. And he built one of the better money management firms in the Boston area. And he's quite well known for his philanthropy, but also for predicting bubbles. And he also says the Fed is almost always wrong in predicting recessions. The Fed is not predicting recession now, but he thinks we will have a recession for sure.
Does he think that it's harder to see a bubble now than in the past? Is it more difficult to spot bubbles in an era where people have been grown up, have been raised through the financial crisis and through the Big Short and all the glory around bubbles?
Well, you don't really know you're in a bubble till it bursts, typically. And he's actually pretty good at predicting bubbles, but nobody's perfect at it. And the reason we have bubbles, he would say, is that there's the phenomenon that everybody is afraid that their neighbor's going to get rich and they're going to miss out on it. So they pile in when things keep going up, and ultimately, in a burst, they're disappointed. Pointed out, for example, Sir Isaac Newton, one of the smartest men ever, he got into an investment, thought it was pretty good, doubled his money, got out, and then he saw it kept going up and up. So he mortgaged his house, took all of his money, put it back in, and he lost everything. He went bankrupt.
Physics and market timing maybe don't go exactly together all the time. I'll just say that.
Right.
But there is this question going forward, especially at a time where people are trying to game out where the Fed is, of just the cross currents and the uncertainties and how much the U.S. can continue to diverge from other places. Does he seem to think that that's overplayed based on the AI bet, that sort of people are not looking at history and that they need to more to really understand this?
Well, I think looking at history would be something he thinks is a good idea, because if you look at history, you'll see that when you have these kind of inflated bubbles, inevitably they're going to burst. And so we've had many bursts. The dot-com bubble is where he really made his name, because he was, in effect, predicting that would happen in 1998, 1999, and 2000. And his firm did quite well, avoiding the tech bubble that existed then. He's actually a legendarily smart person about predicting follies of the markets. And he's not afraid of telling you that you're not smart, you're stupid, you're doing something wrong. He's not afraid of actually going against the conventional wisdom. Very often people don't want to offend other people by telling them they're not that smart, but he's willing to say, you're wrong about this.
But this is why this conversation is so important, folks. 9 p.m. tonight, Rubenstein, Grantham. David, you're one of the congenital optimists out there. You have put money where mouth is on the artifacts, the heritage of the American financial experiment, the Magna Carta purchase that you made, and the others. I'm not going to say you're the polar opposite of Mr. Grantham, but there's a built-in Rubenstein optimism. Do you maintain that, even with the, not perma-bear, but the perpetual caution that we witnessed with Jeremy Grantham?
Well, he's much more bearish and much more negative on things than I am personality-wise, probably. But, that takes a lot of courage when you're telling people they're wrong all the time. That's not easy to do. So I'm probably not as good at telling people they're wrong to their face as he is. But he's willing to tell people you're wrong and you're making a big mistake.
All of us rocked by the climate change stories of the summer, this, that, the other thing. What is his prescription to have America address facts of climate change?
Well, he thinks we're not doing enough for sure. Now, he can't solve all that problem himself, but what he's doing is taking most of his money now and investing it in green tech companies, venture capital kind of companies, small ones, hoping that one thing will come along that will actually make a big difference. But he's not trying to influence our government policy by going down and lobbying. He's past that. But he's actually a very, very clever person who now has made his main focus in life climate tech and investing in things that are going to maybe help with climate.
You've said several times he's not afraid to tell people to their face that they're wrong. Has he said that to you?
Well, he hasn't said to me I'm wrong, but necessarily. But I think generally, when you're predicting people, or you're predicting bubbles are going to burst, you're telling people 90% of the people they're wrong, and he's not afraid of telling people they're wrong. You got to have a certain kind of personality. Probably he's better at it than I would be.
The idea of investing in niche companies, sort of what Tom was talking about, whether it's climate change or whether it's some of the venture capital that other people are doing, is that a more sure bet from your point of view now at a time where there is such a high degree of uncertainty on a macro level?
Well, on climate tech? Or
just in general, broadly, like this sort of niche concept of just going at things very specifically with a smaller pool of money. Is that a sure bet to make bigger returns?
There's no sure bets anywhere, of course. I think the biggest concern that I would have is that we're not quite past the point where we know there's not going to be a recession. I don't think we will have a recession, but nobody knows for certain. You don't know it until you get into it. Right now, the conventional wisdom in Washington is that we've gone past the likelihood of a recession. And there are some people like Jeremy Grantham who thinks that we may have a recession, but it may be next year, not this year. As you know, there was a prediction of a hard landing, maybe by the end of this year, but now most people would say probably not going to have a hard landing by the end of this year. But as the next year, that's when Jeremy Grantham thinks there will be a recession, sometimes next year. And again, predicting recessions is a fool's errand. It's very difficult to do.
Dave, I got time for one more question. It's really important. The quarterback for Duke is just totally irresponsible. He had late homework, and he had to do a whole video asking the professor to delay his, to get his homework in so he get a quality C. Riley Leonard of Duke University. I mean, is he destined for a Carlisle internship? I mean, where are we on this? I need to make some news today. Help me.
Well, I think in college football and college basketball today, you can make more money playing college basketball and college football than going to a private equity firm.
What did you think of the Citadel internship? The salaries they're getting? Did you see that last week? They're making ginormous money.
Well, Citadel is a great firm, and it's got a great leader, and they're making a lot of money, and I guess they're paying out a lot of money. They want to get really smart people, and they can pay up for it.
But what was your first internship in finance? Where you walked in the door and said, "I'm just glad. Can I get your?"
I didn't have an internship in finance. I think my first job was probably selling magazines door to door or something like that. But I didn't have a finance internship, really.
David Rubenstein here. Riley Leonard, if you're listening to this morning, call 1-800-RUBENSTEIN and you get that Carlisle internship going. Duke, I mean, it's exciting. It's college football season.
Yeah, it is. And that was quite a game that they delivered. I'm sure you'll be hearing a lot about it in your next hour with Paul Sweeney, who might be very excited.
He will, but Colorado Buffaloes, Ralphie comes out in the field. It's like a real buffalo. Comes out in the field. Deion's going, recruit him. We can have him as a defensive tackle.
Yeah, we could bring him in here.
Buffalo's beat TCU. It's very, very exciting. Tonight, rather this afternoon, I'll get it right. Tonight, this afternoon, actually a really timely conversation. Lawrence Culp, GE Chief Executive Officer, an update there, to say the least. 1:30 this afternoon. This is Bloomberg. Good morning.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get back to work. Live from New York City this morning. Good morning, good morning. Your equity market slightly negative on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, economic data keeping Chair Powell on the sidelines. Goldman Sachs cutting recession chances to just 15%. And President Biden making his Labor Day pitch. We begin with the big issue. Goodbye August. Hello September.
We're heading into September.
A seasonally weak September.
There is a seasonal aspect to September.
The seasonal trends tend to be negative.
September's the worst month of the year.
The weakest month of the year.
We could see continued volatility.
We have the return of student loan payments.
That very important Fed meeting.
We're heading into September with very strong positive economic momentum.
We got a nice employment number.
Pretty good report.
You're seeing the kind of Goldilocks scenario that the Fed wants.
The Fed that is likely to press the pause button on the rate hiking cycle.
That's a pretty good backdrop for risk assets.
The economy in general is on decent footing.
We are on a wait and see.
More patience is warranted.
Kicking off the show with Citigroup's Stuart Kaiser, Jim Bianco of Bianco Research. Jim, great to catch up with you as well, Stuart. Jim, I want to start here on the Federal Reserve. Rate hikes on ice. Is that what they're going to say?
I think so. I think that they're going to probably pause at the September meeting because the market is giving you less than a 10% odds. But the question will become the November meeting because those are a lot closer to 50-50, and we'll have to see how the data plays out from there.
Stu, is that the Citi view as well?
Yeah, Jonathan, good morning. I think the base case is just that. They'll pause in September, but they're going to want to keep November in play, just because they're going to want to respect the fact that they don't know how data is going to come in, and I think they want the market to just not price them as completely done with the cycle. So, yeah, pause in September and keep November kind of on the table just in case.
Bond market yields high this morning, 10-year up by 4 basis points, right now 422, 2-year up by a couple of basis points to about 489 or so. Jim, I'm struggling with the consensus view coming into September in this bond market at the moment. What is that consensus view now?
I think the consensus view is bullish. A lot of people are looking for a recession. They think that the inflation problem has been vanquished. They're looking at the data and they're seeing in the futures market a big short position, but that's probably a basis trade. And once you've taken that out and you look at positioning or you look at economist opinions, they're all kind of looking for rates to fall. And the contrarian play would be a further rate hike, or further rate rise, excuse me.
So sticky inflation, no cuts, stronger growth. Contributing to that, Jim, maybe this headline, just dropping across the Bloomberg. Excusing me for being distracted. Saudi to extend voluntary cuts of 1 million barrels a day until December, the end of December 2023. Looking at the oil market right now, 5-day rally coming into today. Crude with a pop, 89.64, just short of 90 here on Brent crude, up by 0.75%. Jim, a word on crude. Is that a reflection of a better demand backdrop, or is that just the supply story playing out?
Well, I think it's more of a demand story because you got to keep in mind since late June, crude oil prices are up more than 27% right now. Gasoline prices haven't caught up with it, and they probably will. When you see a big move like that, and yes, I know the Saudis have been voluntarily cutting. They've extended their cuts, but those have been in place for months. It's more consistent with a strong Atlanta Fed GDP and strong data and downgrading the probabilities of a recession because people are consuming energy because the economy is moving forward. I think that that will continue to be the case. In other words, crude oil and gasoline prices might be a market-based measure of economic demand, and right now they're both very strong.
New highs for the year on crude right now, just short of 90. It's the South rally, Stuart Kaiser, hardly anybody's talking about. What do you make of it?
Look, I think our view here is essentially what Jim described, which is economic data continues to come in strong, and that's pushed cyclical assets, higher and also pushed yields higher. I think the big risk here, is, as we've talked about in the past, Jonathan, is that expectations have gotten a little bit more stretched. And the reaction function of equity markets to that data and actually to the rise in yields have become a little bit more troublesome. So, as a base case here, we're still relatively positive on the markets, strong labor market, easing inflation. But, there's definitely some fraying around the edges that I think you need to respect.
Well, Stuart, to build on that, this was a rally so far year to date that has been built on top of upside surprises. Economic data coming in better than expectations. Can you make the same argument that we can build a rally on a series of downside surprises?
That would not be our view. I mean, look, we believe equities are a nominal growth asset, and I think if you start to see disappointing economic data, you don't want to step in front of that. You want to let that weakness happen, and you want to buy at a lower level. So I think from my perspective, I agree with you. I think positive economic growth surprises what's driven the market higher this year, and that works in both directions. And if the nominal growth starts to weaken, I don't think that's something that you want to trade to the upside from an equity perspective.
Here's another headline, 2 in the last couple of minutes. If you are just tuning in, let's get up to speed together on the commodity market at the moment. The first headline from the Saudis to extend voluntary cuts of 1 million barrels a day until the end of December 2023. The second headline, this one from Russia to expend a 300,000 barrel a day oil export cuts through December. They're trying to support the crude market. Jim, I'm going to throw in iron ore as well. So crude at new highs for the year. Iron ore at highs we haven't seen since maybe April. This all happening with a slowdown developing in China. Jim, what's the signal you take from that?
Look, I think when you look at the broad commodity markets as they move higher, especially in the industrial metals where iron ore is and in energy, the takeaway is that the economic strength or the nominal growth in the economy globally is stronger than people think. Yes, China is slowing down, but it seems like the rest of the world, even though we keep talking about recession and slowdown, seems to be compensating for that, and that's why you're seeing higher commodity prices. And if we are seeing higher commodity prices, eventually that should translate into higher yields. Again, as we talked about earlier, at the same time when everybody's positioning themselves for a fall in interest rates.
Well, right now it's fueling higher crude prices through 90 on Brent. Brent crude at $90 a barrel, up by more than 1% on a session. WTI crude just short of 87 here at 86.99. Turns through 87 briefly, up by 1.8%. Jim, let's stay on top of this oil story. Have we seen enough from China? Enough from China, from your perspective, to suggest they can put a floor under this growth risk now?
Not yet. I think that the Chinese have really got problems with their property market, and they've got other issues they have to deal with before we start to say that there's a floor there. Now, maybe it's priced in and their financial markets might bottom, but their economy won't. And let's keep in mind what extraordinarily is happening there. They reopened after zero COVID in January. And yet it might wind up being that this year is the same growth or worse than the year that they were welding people into their houses last year, which is an incredible statement to say on its own. And it underlies the big problems that the Chinese economy has, which is why I don't think I've seen enough to say that they've got a handle on it. And it isn't just that they need a couple of more basis points cut from the central bank in order to spur growth. It's much more structural than that.
Stuart, how does what happens in China shape your view of what happens here?
Look, it definitely matters. I think the narrative around China and the impact on U.S. equities has shifted over the last month. You know, initially it was China's exporting deflation, and that's going to be positive. It's going to help the Fed. I think that discussion has frankly shifted to something that's more about a negative growth impulse and potential event risk coming out of China. So I think it does create a headwind from it. Also impacts European equities, particularly German exporters and luxury good manufacturers. So there's definitely an impact, and I think the narrative around it has shifted much more negative over the course of the last month or so.
It's certainly amazing to see growth in China disappoint, coming much, much lower than expected in 2023 relative to expectations of 9 months or so ago at the start of this year, and see crude back with a 90 handle on Brent. That's the latest for you this morning. Two headlines, one from Saudi, one from Russia. Saudi Arabia to extend voluntary cuts of 1 million barrels a day until the end of December 2023. Throw in Russia to extend 300 barrels a day oil export cuts through December. And you've got the recipe for a higher oil price right here, through 90 for the first time since November. That is a new high for 2023. Crude right now, Brent up by 1.3%, WTI up by 1.9%. To Jim Bianco's point on the bond market, fueling maybe some upside in yields here. Treasuries down, yields up by 5 basis points on a 10-year 4.22. Levels we've seen through much of this morning, up by 2 basis points on a 2-year, up to about 4.90 on a 2-year yield right now. Jim and Stuart are going to be sticking with us. Let's get you some movers elsewhere, with equity futures still just about negative by 0.1%. Here's Simone Foxman.
Yeah, John, equity futures may be looking negative, but Airbnb shares are rallying after it was announced that it would be included in the S&P 500 index as of September 18th, that along with Blackstone. And this really highlights the importance of passive index funds, because as we speak, the local law 18 in New York City is going into effect, and that severely limits the company's operations. But we see shares still up over 6% in the pre-market. Also watching shares of Nikola, there were local news reports of a semi-truck fire at Arizona Lithium facility in Tempe last night. There were no injuries reported, but there have been a lot of concerns about the possibility that there are battery problems that cause fires in Nikola's electric trucks. We're also closely watching Warner Brothers Discovery. We're not seeing a big movement at the moment right now, but we're the company guiding lower adjusted EBITDA for the full year after a $300 to $500 million hit from the impact of these strikes. That despite the fact that Barbie has become the best grossing movie worldwide this year, John.
More from Simone around the opening bell. That opening bell about 20 minutes away. The latest in the oil market, 6-day rally on Brent crude, up another 1% today, briefly through 90, just about there right now. $90 a barrel for the first time since November, as the Saudis and the Russians keep pulling back. Coming up, President Biden making his Labor Day pitch.
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union.
Latest from Anne-Marie, up next.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep,
mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union. I'm proud to be the most pro-union president according to the experts about in American history. And by the way, I make no bones about that.
The president attempted to shore up ties with labor unions in Pennsylvania, downplaying the threat of a potential auto strike, telling reporters, quote, "I don't think it's going to happen." The contentious negotiations leaving an opening for Republican frontrunner Donald Trump.
What's happening to our auto workers is an absolute disgrace and an outrage beyond belief. Both the UAW bosses and the big three auto executives should be screaming at the top of their lungs. They should be ashamed of themselves, demanding that Joe Biden cancel his brutal electric vehicle mandate before it destroys the entire U.S. auto sector. To every auto worker, I stand in total solidarity with you in your fight against Joe Biden's job-killing Green New Deal insanity.
Donald Trump on the offensive as voters overwhelmingly think President Biden is too old to run for re-election and giving him low marks for his handling of the economy, according to a new Wall Street Journal poll out in the last couple of days. Bloomberg's AMH joins us from Washington, D.C. Anne-Marie, who's going to win that battle for those unions?
Well, for the UAW, Jonathan, at the moment, it's still up for grabs in the sense that they have not come out and endorsed anyone. And they've said that people in Washington need to take note about what is going on. If they want our endorsement, they need to be there for us. So that is something you see the former President Donald Trump try to tap into. He was out with a Truth Social post yesterday about this, saying there's an EV glut and UAW should not be backing the Biden administration. We should note the UAW did back Biden in the last round. They likely will lean towards the Democrats, but they're probably just using this endorsement as leverage at the moment, the same way they're using a strike as leverage at the moment, as they are up against the three big auto companies. And Jonathan, that contract expires September 14th. And when you heard from President Biden yesterday, is that when he said he didn't think there would be a strike, Sean Fain, the UAW president, came out and said he must have more information than we do.
AMH, the president says he's the most pro-union president ever in the history of the United States. I have no idea what that means. Isn't this the most easy time to be the most pro-union president of the United States, given where union membership is relative to where it was decades ago?
That is true. Relative to decades ago, if you look at the 1970s, an organization like UAW had more than 1 million workers. Right now, it's a few 100,000. But at the same time, the president does want to make sure that he is talking about labor unions. He talks about the fact that he's a son of Scranton. This is where he was talking on Labor Day in Pennsylvania. This is something he wants to lead into. His biggest issue, though, Jonathan, is one of the biggest gripes the UAW has is with the electric vehicles. When you see this administration come out and talk about loans or subsidies or grants for companies to build battery plants, the UAW, they do not have kind words for this administration.
His biggest issue this morning is in the oil market. Anne-Marie, let's go there. Two headlines in the last 10 minutes or so. One from Saudi Arabia, one from Russia. The message pretty clear. We're not going to stop pulling back anytime soon. How do you think this White House responds to that?
Well, Jonathan, this kind of goes to their industrial policy of wanting to electrify the grid. They wouldn't have to worry as much about what Saudi Arabia was doing. What we're seeing from the Saudis is that it's prolonged this cut. We didn't think it was going to be this long, and that's why you see Brent prices spiking above $90 a barrel. The administration was already concerned with gasoline prices. They're nowhere near they were last summer when they hit above $5 a gallon, but they are trending towards $4 a gallon. That will be very difficult for this administration that is still dealing with inflation. Yes, the rate of inflation is slowing, but they're still dealing with inflation. This continues to show up in polls, and it's why the Americans give the Biden administration poor marks on the economy.
$90 Brent right now on the screen at 1.5%. AMH, thank you. Anne-Marie with the latest down in Washington, D.C. Some final thoughts from Stuart Kaiser, Jim Pienko. Jim, let's pick up on that crude story. Crude right now at 1.5%. September 20th, the Federal Reserve. We can work backwards. September 13th. Is CPI. Jim, some upside risk to the inflation story into year-end from your perspective?
Yeah, I think on two levels. On first level is that September of last year was a small number. It was 0.2. We're looking for somewhere between 0.6 and 0.8 for this month. In other words, a base effect that could push year-over-year inflation up to 3.7 or 3.8. And if you extend that through the rest of the year, it really does look like year-over-year inflation bottomed at 3% in June, and it's going to probably start drifting towards 4%. Now, that's not catastrophic, but it's certainly not the type of number that's going to get the Fed to be talking about 4 rate cuts next year if we end the year at 4% inflation.
Stuart, how would you expect equities to trade around that kind of story? If Jim's right, what kind of price action would you be looking for?
Yeah, I mean, our view is pretty similar, is that you probably saw the 2 weakest prints you're going to see this year over the summer, and, potentially, A, some upside risk, and B, you're probably just also going to tick higher relative to those very low numbers. My view here is as long as inflation volatility remains relatively well contained and you're kind of in a slowly easing or grinding lower type inflation environment, equities should be okay. If you saw something like 0.6, 0.8 and inflation actually hooked higher, obviously the market would have to price that risk a little bit. But big picture, inflation volatility's come down. The rate of inflation has sort of stabilized a bit. And I think, what equity markets want is clarity and certainty. So if you have sort of stable inflation, stable jobs, I think equity markets can handle that pretty well.
Stuart, over the weekend, I was reading through it. You gave a base case, a tactical view, and a contingency plan. Stuart, can you go through that for us now?
Yeah, sure. Our base case, as I mentioned, is, job market remains pretty solid. Inflation is easing, but a little bit sticky. And I think, that allows equity markets to work, probably with, not the type of velocity we saw earlier this year. Tactically, we do like hedging markets. There is the chance here that inflation does tick higher. You're running to the show, mentioned seasonality a few times. So that's obviously a risk in the background. China, higher rates. Market technicals, options flows. There's a lot of tactical reasons, I think, to be a little bit careful, and we do like hedging through till the end of the quarter. The contingency, though, I think is the key thing here, and it's what could really disrupt this rally. And we've put 3 things out there, but number 1 on that list is U.S. labor markets. And I do think if you see U.S. labor markets continue to start to weaken, meaningfully, then you are going to see equity markets trade lower. Our view is you don't want to step in front of that. You don't want to buy the first sign of weakness. You kind of want to let that weakness play out. So the contingency for the markets here is the strength we saw in the labor market on Friday, doesn't get repeated. Labor market and services sector comes under pressure, and I think that's your bigger downside risk. Hedging-wise, we would focus on U.S. retailers as a way to play that story.
In other words, Stuart, bad news is just bad news.
Always. They wouldn't call it bad otherwise, right? They would call it good if it was good.
Jim, you on the same page?
Yeah, I am. I think that definitely on the page that, bad news might wind up becoming bad news as we move forward from here. But I think that when you look at the labor market, I want to go back to what you and Anne-Marie were talking about. The labor situation, especially among unions, which is only 6% of the labor force, is getting to be very substantial. I think one of the things the UAW is looking at is a 32-hour work week, a 4-day work week. They want to go hybrid like everybody else does. And these are intractable problems. So the labor market could give us quite a bit of volatility as we move forward, unless there is some kind of a deal. And then you've got potentially a transit worker strike in New York City coming right after that for the same reasons.
Sign me up, Jim, not for the strike, but for the 32-hour work week. Now, Jim, you mentioned the union membership and how low it is, particularly relative to where it was several decades ago. You can make the argument that maybe these negotiations are meaningless for the overall labour market. Do you think there's a signal effect here, though, Jim, that we all see those headlines, we get to year end and we say, you know what, I'll have some of that as well?
Oh, yeah, I think it all started with the UPS workers getting $170,000 a year to deliver packages, that is reverberating through not only the West Coast port, but, the UAW and the transit workers and everybody else is saying, I want to get some. And yeah, you're right, 94% of the workforce is not unionized, but that 6% is. If they walk out on strike, like the Hollywood writers' strike, another one, it can be very disruptive for the economy as we go forward.
I'll form a union for the three of us, guys. 32-hour work weeks coming up. Jim Bianco, Stuart Kaiser, to the both of you. Thank you, guys. Going into the opening bell, about 7-8 minutes away. Equity futures here on the S&P 500, slightly negative through most of this morning. On the S&P at the moment, we're down by 0.15%. This big move in the commodity market over the last couple of weeks. This is day 6. A 6th day of gains for Brent crude, through 90 for the first time since November. So we have a new high for 2023, $90 and about 60 cents, up by 1.8% off the back of these headlines that Russia, Saudi Arabia are going to keep on pulling back. Just keep on pulling back. The latest headlines from Saudi to extend the voluntary cut of 1 million barrels a day until the end of December 2023. And right at the same time, Russia to expend the 300,000 barrel a day oil export cuts through the end of the year as well. Crude up this morning by 1.76%. Coming up in the morning calls and later, Goldman Sachs growing more confident about a soft landing in the US. We'll have that conversation with PIMCO's Tiffany Wilding.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
This is where we've been all morning in equities, just a little bit softer on the S&P, down by about 0.1%. That's the price action. Let's get used to morning calls. First up, RBC upgrading American Express to outperform, pointing to manageable credit trends and the company's double-digit revenue growth outlook. The stock is up by 1%. BNP downgrading General Mills to neutral, expecting cautious consumers to spend less on premium pet foods. The stock is down by 0.8%. And finally, Bernstein upgrading Lowe's to outperform, seeing a favorable setup with multiple catalysts on the horizon. The stock is up by 0.6%. Coming up on this program, we speak to PIMCO's Tiffany Wilding on what she calls a Goldilocks jobs report. That conversation up next, your opening bell, just around the corner.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Twenty-five seconds away from the opening bell, coming off the back of the best week of gains on the S&P 500 since the middle of June. Futures right now negative by 0.1%. On the Nasdaq, down about 0.2%, with Fed rate hikes seemingly on ice. More data still to come before we get to the 20th. The 13th is your next CPI report. There's your opening bell. Switch to the board and get to the bond market. Yields look like this at the Treasury market right now. Yields higher by 4 basis points. $4.22. Dollar stronger. The euro down to 107.45. We're negative by 0.5%. The lowest, the weakest euro, going back to about June. The rally in the commodity market getting everybody's attention. It is day 6 for Brent crude. It is day 8 for WTI. Brent crude is up by a couple of percentage points and through 90 for the first time going back to November. For WTI, longest winning streak going back to the start of this year. WTI crude, $87 and about 20 cents. We're high here by 2%. That's the cross-asset price action at the moment. We need to look at one thing, ARM, one of the most anticipated stock listings of the year so far, downsizing its IPO and now planning to raise as much as $4.87 billion in what would still be the biggest IPO of 2023. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. According to the Form F1, ARM will offer $95.5 million shares, 955.5 million shares in the form of American Depository Receipts, or ADRs, priced currently in a range of $47 to $51 each. As you said, that would see them raise $4.87 billion. Even at the bottom end of that range, if they price at $47 a share, it would still make this the biggest IPO globally of the year, surpassing Johnson & Johnson's consumer health spin-off of Kenvue. You'll remember that came in raising $4.37 billion. A lot of interest here, partly because we see it as a kind of starting gun for the IPO window for technology companies. There are a number waiting in the wings, as you know. Previously, we believed that ARM wanted to raise between $8 and $10 billion at a much higher valuation, say $60 to $70 billion. But what happened or transpired was SoftBank acquired the 25% stake of ARM that the Vision Fund held. And we know that all told after the transaction, SoftBank will still control 90% of the shares, which is an interesting dynamic given the kind of big name cornerstone or anchor investors that are on this deal, which include Apple, Nvidia, AMD, Alphabet, Intel, among others that Bloomberg's reported, but certainly one that we're watching very closely.
Ed, let's make it really simple. So they're going to raise potentially half of what they hoped to raise only a few weeks ago. In terms of the valuation, it might be in the 50s. They were hoping it would be closer to 70, at least in the 60s. Ed, is that a SoftBank problem or a broader market story?
I think a mechanical problem. You know, it's by virtue of the transaction that SoftBank's done. I think, like, even based on the math that Bloomberg's done, at the top end of the range, $51 a share. It will have a valuation of $54.5 billion. You know, part of the psychology of this whole IPO situation and ARM going first is a lot of names that are waiting in the wings, want to see how it's going. But ARM, like everyone else, and SoftBank, by virtue of holding 90% of the company, wants to leave a little room for upside. That's what I keep hearing from bankers and sources that I speak to in the tech industry. And remember, ARM aside, a lot of these companies went through painful down rounds over the last 18 months, but with the longer term goal of going public and having some potential upside out of that being the motivating factor.
Just set the bar a little bit lower. Thanks for the update.
Exactly,
Thank you, buddy. 3 minutes into the session right now, negative 0.1% on the S&P, pulling back just a touch on the Nasdaq by 0.4. Let's stick with the tech sector. Barclays upgrading Oracle to overweight with a street high price target. The analyst writing this: we see a multi-year opportunity for solid growth at high margins, partly fueled by emerging AI workloads, which will be the key to the overall story. Isabel Lee has more. Hey, Isabel.
Hey, John, and that price target is now one of the highest in the street, from 150 to 150 from 124. And 150 is a 24% increase from Friday's close. Barclays sees scope for strong growth at high margins, and that's supported by Oracle's software as a service and its cloud infrastructure, both of which it said can outweigh lower growth parts of the business. And just last week, UBS also upgraded Oracle to 140. UBS is also citing the cloud infrastructure as well as the GPU capacity of Oracle. AI really seems to be the theme of the year, John. And recall in March, NVIDIA extended its collaboration with Oracle, also in relation with its cloud infrastructure. And as UBS said, the AI story still has a lot of room to play out. Oracle is now up some 50% year to date, John.
And up about 0.4% this morning. Isabel, thanks for the update. Thank you. I want to turn to some new names potentially on the S&P 500. Both Blackstone and Airbnb will join the index prior to the opening bell on September 18th, replacing Lincoln National and Newell Brands. Simone Foxman on top of that one. Hey, Simone.
Yeah, this is a long time coming for both of these names, which have multiple share classes. And that was something that wasn't able to be allowed. You couldn't be in the S&P 500 index if you had multiple share classes until the S&P Dow Jones repealed this rule back in April. So just to recap, to qualify, you have to be a highly liquid U.S. firm. You have to have a market cap of at least $14.5 billion, and you have to meet certain metrics of profitability, liquidity, and share float standards. Now, Blackstone will become the first alternative asset manager to ever be included in the S&P 500 index. This despite the fact that it went public back in 2007. But after they dropped the rule, both Airbnb and Blackstone seen as benefiting here. And of course, this despite some unfavorable rules that come into effect for Airbnb today. We can see the impact on the shares, rallying 3%, over 3% for Blackstone, over 7% for Airbnb. John.
Simone, thank you. 5 or 6 minutes into the session, your update right now, negative 0.2% on the S&P. No drama there on the Nasdaq, down by 0.4. Now, I'm not sure what would make you more miserable, being a Manchester United fan over the weekend or holding the stock this morning. I'm looking at my floor manager right now, who is a Manchester United fan. Stick with me. The stock is down by about 11.4%. 5 minutes into the session, as Man United may be taken off the market after the Daily Mail reported that the Glazer family isn't getting offers matching their asking price, writing, quote, "The Glazers are thick-skinned and won't be influenced by any negative fan reactions." Katie has more. Hey, Katie.
Hey, John. Yeah, you take a look at shares this morning, currently off by 11.5% after the report in the Daily Mail over the weekend. According to sources, the Glazer family, that thick-skinned family, they originally hoped to attract multiple serious bidders here, but only ended up with two. We're talking about Sheikh Jassim of Qatar and Jim Ratcliffe. Now, the Glazer family reportedly taking the team off the market. They're going to try again in 2025 when hopefully improved conditions will attract more bidders. And the Glazer family is looking to sell the team for between 7 to 10 billion euros at that time. Again, according to Daily Mail sources, as of Friday's close, you look at the market, Manchester United valued at $3.9 billion or about 3.6 billion euro. Now, it's worth noting here that when contacted by Bloomberg, a team spokesperson declined to comment on, quote, rumors and speculation. But even still, you can see the drama playing out in the stock market. Shares now off by 11.7%. If that holds, John, it'll be the worst day since February.
Did they comment on the Arsenal game? Katie, that's what we all want to know.
I barely know what we're talking about here, John, but I'm not sure.
We appreciate your honesty. Katie, thank you. On top of the stock, more than the game over the weekend. Would you like to talk about? No, don't want to talk about the Arsenal. No? Okay. Goldman Sachs cutting its US recession odds down to 15% from 20, writing this. Real disposable income looks set to reaccelerate next year on the back of continued solid job growth and rising real wages. We still strongly disagree with the notion that the long and variable lags of monetary policy will push this economy towards recession. PIMCO's Tiffany Wilding offering her own assessment after Friday's payrolls data, writing the following. This was a Goldilocks report for the Fed. Labour markets are cooling but not falling off a cliff, and the slowing is likely to continue as the economy faces various headwinds in the second half of 2023. I'm pleased to say that PIMCO's Tiffany Wilding joins us now for more. Tiffany, let's start there. The kind of slowing that you're expecting into year end for some really phenomenal numbers we're seeing in the third quarter.
Yeah, well, certainly consumption has been the standout this year. The consumer's been very strong, and that's pretty aberrant from historical hiking cycles. You do tend to see more moderation in consumption as labor markets slow. We're just really not seeing that. Consumption in the third quarter looks like it's running above 2.5. Obviously, GDP tracking reports also look like they're closer to 3. So this is an economy that just doesn't seem to want to quit. Now, nevertheless, though, we are seeing indicators, higher frequency indicators that would suggest that things are slowing. So we have student loan repayments that are starting. Treasury daily data suggests that people are actually prepaying that. And at the same time, they're spending less. So high frequency data from credit cards suggests that we are seeing consumers that are starting to pull back. Add to that, that you have seen much less credit creation overall for the economy this year, and that is a recipe for slowing. Now whether it actually pulls us into a recession or not, I think that's more of a question mark here, just because of the ongoing resilience in the U.S. economy.
Well, do you see us on a path towards returning inflation to 2%? Are you confident we're on that path, Tiffany?
Yeah, well, we're certainly going to get some good news on the inflation front in the back half of this year. But really, that good news is centered around some of the pandemic-related effects just fading. Of course, things in China have been much weaker than expected. They are, as a result, exporting some disinflation. That's going to help U.S. retail goods prices going into the holiday season, which many consumers will be happy about. But nevertheless, other measures of inflation, wages, for example, in the United States, they still look sticky. This super core measure that the Fed loves, services ex shelter within the PCE inflation measure, also still looks relatively elevated. So one of the things that we've been noting, and this is consistent with the Fed's forecast, is that you do need to see some labor market cooling in order to get that down. And I think it's a question on whether we'll see some labor market cooling just because the economy's been so strong.
That's the labor market, throw in housing as well. Tiffany, we could look at commodities too. Can I just get a comment, Tiffany, potentially from you on whether this commodity market move complicates the Fed's effort with Brent, WTI back in and around $90 a barrel?
Yeah, well, certainly, headline inflation matters. It matters for how consumers think about future inflation and inflation expectations. But on the other side of that, it also matters because higher gas prices will affect consumers' ability to spend on other discretionary items. So it's a little bit of a mixed bag in terms of how it affects the economy. We still, in terms of the underlying inflationary pressures, we like to look at core inflation. And again, that's going to look a lot better in the second half of this year, with some risk, though, that maybe it reaccelerates if the economy doesn't cool.
So, Tiffany, when we get forecasts next up from the Federal Reserve, how do you think they'll compare to the last set of forecasts we got earlier this summer?
Yeah, so they're going to be a bit of a mixed bag in terms of their implications for the rate path. So we do think Federal Reserve officials will have to revise down their core PCE inflation forecast, at least for the end of this year. But at the same time, they're probably going to be revising up their growth forecasts. And there's been some good news on the labor market front. They could have to revise down their unemployment rate forecast. So all of that, sort of suggests, maybe they keep that rate hike in the back half of this year. Maybe they don't. But this is coming up in September. We would also argue there's a lot more data between now and the end of this year for them to think about. And I guess overall, just looking out to 2024, if the economy is not cooling, if we are still running at above trend growth, if the labor market, the unemployment rate is still at these levels, kind of 3.5 to 3.8, it's possible the Fed might even have to do more. So I think that's something that that we're grappling with. Not our base case certainly, but
sure.
Something that's the risk that's out there.
Well, let's take it one step further. Let's play what if for 2024. Tiffany, are you still of the opinion that let's say inflation is 2 point something, that they won't be willing to do anything about it. They won't be willing to crush the economy or the labour market. They'll just tolerate 2 point something.
Yeah, certainly. I mean, I think if it's a two-handle, that's probably good for the Fed. But I do think there's questions around if the labor market remains this tight. It could stay around 3, which is a little bit more cuspy. Yeah, but overall, I mean, I think there is a question around if you get it down to 2.5, let's say, and you continue to forecast it moving lower over the next few years, then maybe that is all you need to do. And that would be very similar to what the Fed did in the 90s with their opportunistic disinflationary strategy. And I would say if you look at economic performance in the 90s, it was pretty good. And overall, 2 is really not. It's not a magic number, if you will. I mean, it's 2% inflation. That there's not a lot of cost-benefit analysis around 2 versus 3 versus price stability in terms of their target. Nevertheless, though, as Chair Powell said, they're probably not going to change their inflation target, but they could alter their strategy within that target, to let it go a little bit above for a period of time.
Tiffany, thanks for the update. As always, one of the best. Tiffany Wilding there at a PIMCO on the look ahead for 2023 and 2024 as well. This just in from Anne-Marie. AMH wants you all to know that Man U goal was offside over the weekend, for whatever that's worth. 14 minutes into the session, your equity market slightly negative on the S&P. Coming up, China's big breakthrough.
China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry. So the second prong of the strategy, holding China back, has taken on more prominence in recent years.
AMH and Ed Ludlow, your team coverage up next.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey,
couldn't you have made the stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry, and that's why the US, Japan, and the Netherlands in particular have tightened up their export controls on chip-making tools, which now can no longer be transferred to China to help China produce cutting-edge chips. And so this second prong of the strategy, holding China back, has taken on more prominence in recent years.
Chris Miller there of Tufts University weighing in on China's chip race as the US-China tech war heats up. A major breakthrough in the last week, a teardown of Huawei's newest smartphone revealing an advanced 7-nanometer processor. A sign Beijing is making progress in a nationwide push to circumvent US sanctions. Your team coverage starts right now with Bloomberg's Anne-Marie and Ed Ludlow. Ed, just how big of a breakthrough was this for China?
Well, in layman's terms, this is the best ever made in China chip. That's the easiest way to understand it. 7-nanometer nodes are, for China, where they're at in chip manufacturing. You'll remember on the show a week ago, Jonathan, there were local media reports and speculation that the processor in the Mate 60 Pro might be 5-nanometer. And that was very surprising because broadly the industry does not think China has got to that stage. What the teardown that you're looking at right now, and actually any second you will see the processor known as the Kirin 9000S processor confirms, is that it is 7-nanometer. That is 2 generations removed from the cutting edge, which is 3-nanometer. But what's so important is that Semiconductor Manufacturing International, when you're looking at the Kirin right now, that is the processor. But what is so important about Semiconductor Manufacturing International, or SMIC as it's known, it's China's leading chip maker, but the US technology curbs apply to their supply chain. So we asked the Commerce Department, hey, this 7-nanometer, is it bound by the existing curbs? And they haven't responded. It's fascinating.
Interesting. AMH, if this is a massive win for China, how big a loss is it for this White House?
Well, Jonathan, just look at the timing of all of this. This Huawei new phone came out at the same time as you had Gina Raimondo leaving China. She was there to try to put some more formal engagement in the dialogue between Washington and Beijing that really has deteriorated in the last few years. And now a big question, I think, facing this administration is that are these sanctions, these export controls to try to stem China away from that high advanced U.S. technology, are they effective? Are they adequate? That is something this administration will be asking. But it was a triumphant in China when you have the Global Daily Times putting out a political cartoon where Huawei is seen as a vehicle, car on the road, busting through a blockade, trying to stop cars from coming in and saying that they are basically free from these U.S. sanctions controls and export controls. So this topic is certainly not going to be going anywhere anytime soon. But I would say it's up to the viewers to decide whether or not they thought it was a coincidence that this phone was released as the Commerce Secretary, the agency that is in charge of these sanctions, she was on her way out.
Well, AMH, I'd go one step further. The unveiling was so quiet, and it came at a time when they had someone from the outside preaching to them about why their economy may well be, quote, uninvestable. Isn't that somewhat embarrassing now for the Commerce Secretary to be preaching things like that at a time when they've been able to unveil something like this?
Well, what the Commerce Secretary was talking about is what U.S. companies are saying about China. What we've seen in China, and Reuters reported this weekend about their fund, they're putting another $40 billion into it so that they have their own domestic production of these chips to make sure that they still are remaining competitive with the United States.
Quite a breakthrough in the last week. Ed Ludlow, AMH, thank you to the both of you. About 22 minutes into the session, we look like this. We're down by 0.36% on the S&P. On the Nasdaq, we're down by 0.38. No drama. Let's get you some sector price action. Here's Simone Foxman.
Yeah, just about every sector in the red this morning, with the exception of energy. Industrials, the weakest today, led by losses in part in airlines. Airlines have had a terrible August, down 9.5% last month. Transportation companies as well feeling the pain. But September tends to be the weakest month of the year over the past 30 years, seen an average change of down 0.7% in the month, so not setting us up well. We are looking at communication services trying to eke out some gains there. Where we are seeing some upside is the energy sector. Saudis prolonging voluntary oil production cuts for 3 months. It was anticipated that they would prolong these cuts, but 3 months is quite a long time. Russia joining in, and we're seeing the benefit to the major international energy companies, Exxon, ConocoPhillips, even Chevron, which is dealing with some labor concerns in Australia around potential strikes, up now more than 1% in today's trading. John?
Simone, thank you. If you are just tuning in, that has been the news of the last hour or so, the last 50 minutes, the developments with Saudi Arabia and Russia. That move on Brent crude up by 1.3%, $90 a barrel for the first time since November. On WTI crude, about 87, up by 1.9% this morning. That's the crude action. Coming up, your trading diary.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 minutes into the session, starting the week a little bit lower, soft and negative, down by, let's call it a third of 1% on the S&P 500. Underperformance on the Russell, the small caps down here by 1.8%. That's equities. Let's take a look at bonds. The bond market right now shaping up as follows. 2-year, 10-year, 30-year yields creeping higher off the back of another rally in crude this morning. We're up by 6 basis points on a 10-year, back to about 424 on a 30-year, further out along the curve, up by 7 basis points to about 436, which incidentally was the high of the year for the 10-year yield in the last couple of weeks. That's the price action. Let's get to the trading diary. The week ahead looks like this. U.S. factory orders and durable goods coming at the top of the hour. The Fed releasing the beige book on Wednesday, plus Fed speak, Collins, Logan, followed by Williams, Bostic and Harker on Thursday. Another round of jobless claims on Thursday as well. And we round out the week all coming ahead of the G20 summit kicking off on Saturday. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news. I'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.